In October 1979, a cigar-smoking economist made a decision that would throw millions of Americans out of work, bankrupt thousands of businesses, and push mortgage rates above 18%. Paul Volcker, the newly appointed Federal Reserve Chairman, deliberately crashed the American economy. Unemployment soared to 10.8%, the highest since the Great Depression. Construction workers couldn't find jobs. Farmers lost their land. Auto dealers went bankrupt by the hundreds. But here's the shocking part. It worked exactly as planned. By 1983, Volcker had accomplished what seemed impossible. He killed the inflation monster that had terrorized America throughout the 1970s. Inflation plummeted from a devastating 14.8% to just 3%. The price was brutal. Over 10 million Americans lost their jobs, mortgage rates hit 18.63%, and entire industries collapsed. Yet economists today call it one of the most successful monetary policy interventions in history. Tonight, we're uncovering the economic story most people slept through. How one man's controversial decision to raise interest rates to an unthinkable 20% saved the American economy by first destroying it. If you want to understand the economic forces that shape our world, the stories that happened while most of us weren't paying attention, please hit that like button and subscribe to The Sleeping Economist. Ring the notification bell, because these are the financial lessons they don't teach in school. Chapter 1. The Inflation Monster of the 1970s. To understand why Paul Volcker took such drastic action, we need to travel back to the 1970s, a decade when America's economy was falling apart in slow motion. Imagine going to the grocery store and seeing prices jump 10% higher every few months. That was life in 1979. A gallon of milk that cost $1 in January might cost $1.15 by December. Your paycheck stayed the same, but everything kept getting more expensive. This wasn't normal inflation. This was economic cancer spreading through every corner of American life. The roots of this crisis stretched back to the late 1960s. President Lyndon Johnson wanted to fight the Vietnam War and launch his Great Society program simultaneously, essentially buying guns and butter at the same time without raising taxes enough to pay for either. It's like maxing out your credit cards to renovate your house while also buying a boat. The bills eventually come due. Then came the oil shocks. In 1973, Arab nations embargoed oil shipments to America, quadrupling oil prices overnight. Suddenly, gasoline lines stretched around city blocks. The shock hit again in 1979, when Iran's revolution disrupted oil supplies. Energy costs exploded, and since everything in a modern economy requires energy, prices for everything else exploded too. By summer 1979, inflation was running at an annual rate of 14.8%. Think about that. If you had $10,000 in savings, it lost $1,180 in purchasing power in just 1 year. People were desperate. They bought cars, appliances, anything tangible immediately because they knew prices would be higher next month. This panic buying only made inflation worse, a vicious cycle economists call an inflationary spiral. President Jimmy Carter faced a nightmare scenario. His approval ratings had crashed to 25%. Americans had lost faith in their government's ability to manage the economy. The dollar was collapsing on international markets. Foreign investors were fleeing American bonds. The greatest economy in world history was becoming a global laughingstock. On July 25, 1979, Carter made a desperate move. He nominated Paul Volcker, the 6'7" president of the New York Federal Reserve, to lead the Federal Reserve System. Volcker was known as a tough, principled economist who understood international finance. More importantly, he had the backbone to make unpopular decisions. Volcker knew conventional medicine wouldn't cure this disease. Previous Fed chairmen had tried gentle interest rate increases, raising rates from 5% to 7%, then backing off when unemployment ticked up. It was like taking half a course of antibiotics. The infection always came roaring back stronger. Chapter 2. The Saturday Night Massacre of Monetary Policy. Paul Volcker's first day as Fed chairman was August 6, 1979. Within weeks, he realized the situation was even worse than it appeared. The Federal Reserve had lost all credibility. When they announced interest rate targets, markets yawned. Investors assumed the Fed would cave to political pressure, just like always. Here's how the Fed typically fights inflation. They raise interest rates, which makes borrowing money more expensive. When loans cost more, people buy fewer houses and cars. Businesses invest less in new equipment. The economy slows down, demand drops, and prices stop rising. It's like tapping the brakes on a speeding car. But Volcker faced a unique problem. Inflation had become embedded in American psychology. Workers demanded 15% raises because they expected 15% inflation. Companies raised prices 15% because they expected costs to rise 15%. These expectations created a self-fulfilling prophecy. Even if the Fed raised rates to 10%, nobody believed inflation would actually stop. On October 6, 1979, Volcker dropped his bombshell. In an emergency Saturday night press conference, unprecedented for the Fed, he announced a complete revolution in monetary policy. Instead of targeting interest rates, the Fed would now target the money supply itself. Let me explain this simply. Imagine the economy as a giant bathtub. Money is the water. When there's too much water, money, sloshing around, you get inflation. Prices rise because dollars become less valuable. Volcker essentially said, "We're turning off the faucet no matter what happens to interest rates." This was radical. By controlling money supply growth, Volcker let interest rates float to wherever markets pushed them, and markets pushed them to levels nobody had imagined possible in America. The federal funds rate, the rate banks charge each other, soared from 11% to 17% within months. But Volcker didn't stop there. As inflation continued raging into 1980, he kept tightening. By April 1980, the prime rate, what banks charge their best customers, hit an astounding 20%. To put this in perspective, if you wanted a mortgage in 1980, you'd pay 18% interest or higher. A $50,000 home loan would cost you $755 per month, but $750 of that was just interest. Almost nothing went toward principal. Home sales collapsed 50% within months. The political backlash was immediate and fierce. Home builders mailed Volcker 2x4s in protest, pieces of lumber they couldn't sell. Auto dealers sent him keys to unsold cars. Farmers drove tractors to Washington, surrounding the Federal Reserve building. One congressman suggested impeaching Volcker. Another called for his hanging. But Volcker had an unusual advantage. President Carter, despite facing re-election, publicly supported the Fed's independence. Carter knew fighting inflation required painful medicine, even if it cost him the presidency, which it probably did. Chapter 3. 20% interest rates and economic collapse. By early 1980, Volcker's shock therapy was working too well. The economy was crashing faster than anyone anticipated. In March 1980, President Carter imposed credit controls, essentially limiting how much Americans could borrow. The combination of 20% interest rates and credit controls was like performing surgery with a chainsaw. The economy collapsed at the fastest rate since World War II. GDP fell 8% in just 3 months. Unemployment jumped from 6% to 7.8%. Panicked politicians pressured Volcker to reverse course. Even some Federal Reserve Board members wavered. In May 1980, Volcker blinked. The Fed loosened policy slightly and interest rates fell from 20% to 11%. The economy immediately rebounded, but so did inflation. By September 1980, inflation was accelerating again, reaching an annual rate of 12.7%. This was Volcker's darkest hour. His half measure had failed. Inflation expectations were now even more entrenched. Critics said he'd made things worse, causing a recession without curing inflation, the worst of both worlds. Ronald Reagan defeated Jimmy Carter in November 1980, partly by hammering Carter's economic record. Reagan asked voters, "Are you better off than you were 4 years ago?" The answer was obviously no. Inflation was still raging. Unemployment was rising. Interest rates remained crushing. But Reagan's election gave Volcker an unexpected second chance. The new president promised to back the Fed's independence, even though fighting inflation would initially worsen the recession. Volcker knew this might be his last opportunity. No more half measures. In December 1980, Volcker struck again. The federal funds rate soared back above 19%. By June 1981, it hit an all-time record of 19.10%. The prime rate reached 21.5%. These weren't just numbers. They were economic weapons of mass destruction. The housing industry essentially ceased to exist. Home construction fell 50% from 1979 levels. The entire savings and loan industry, which had made long-term loans at fixed rates, faced bankruptcy as they paid depositors 15% while collecting 6% on old mortgages. Manufacturing imploded. High interest rates pushed the dollar's value up 50% against other currencies, making American exports impossibly expensive. Steel mills closed. Auto plants shuttered. The Rust Belt earned its name during these brutal months. By July 1981, America had entered what economists call a double-dip recession. 2 recessions back-to-back with barely a breath between them. This wasn't a slowdown. It was an economic depression in everything but name. Chapter 4. 12 million unemployed. The human cost. The human cost of Volcker's shock therapy was staggering. By November 1982, unemployment hit 10.8%, meaning over 12 million Americans were desperately seeking work. But the real number was worse. Millions more had given up looking. Others worked part-time when they needed full-time income. In Michigan, where the auto industry concentrated, unemployment reached 16.9%. In some factory towns, it exceeded 25%. These weren't statistics. They were broken families, foreclosed homes, and shattered dreams. The farm crisis was equally devastating. Farmers had borrowed heavily in the 1970s when inflation made land prices soar. Now, with interest rates at 20% and crop prices falling, they couldn't service their debts. Farm foreclosures reached levels unseen since the Great Depression. The emotional toll was crushing. Suicide rates among farmers doubled. Small businesses collapsed by the thousands. Imagine running a restaurant or retail store when your business loan rate jumps from 10% to 21%. Your customers disappear because they're unemployed. Your costs skyrocket. Your credit line gets called. It was economic carnage. Even large corporations struggled. International Harvester, the farm equipment giant, nearly went bankrupt. Chrysler required a government bailout to survive. Continental Illinois, one of America's largest banks, failed in 1984 from bad loans made during this period. The political pressure on Volcker intensified beyond anything a Fed chairman had faced. Congressional Democrats demanded his resignation. Senator Robert Byrd accused him of destroying the American dream. Even Republicans wavered. Howard Baker, Reagan's chief of staff, privately urged the president to push Volcker out. But something remarkable was happening beneath the carnage. Inflation was finally dying. By October 1981, inflation had fallen to 10%. By November 1982, it dropped to 5%. By June 1983, it reached 2.5%, lower than it had been since the 1960s. The inflation psychology that had gripped America for a decade was finally broken. How did this happen? Volcker's shock therapy worked through brutal simplicity. With unemployment above 10%, workers couldn't demand wage increases. With customers disappearing, businesses couldn't raise prices. With borrowing costs at 20%, speculation stopped cold. The excess money that had been sloshing through the economy dried up. Market expectations fundamentally shifted. Investors now believed the Fed would do whatever it took to maintain price stability, no matter the political cost. This credibility, earned through immense pain, became Volcker's greatest achievement. Chapter 5. The economy that rose from the ashes. By mid-1982, confident that inflation was truly broken, Volcker finally began easing monetary policy. Interest rates fell from 20% to 15%, then 12%, then into single digits. The economy responded like a compressed spring suddenly released. The recovery that began in November 1982 launched one of the greatest economic expansions in American history. GDP grew 4.6% in 1983, then 7.3% in 1984, the fastest peacetime growth since the 1950s. The stock market began a bull run that would last, with interruptions, for nearly 2 decades. But the economy that emerged from Volcker's shock therapy was fundamentally different. Manufacturing never fully recovered. Millions of factory jobs permanently disappeared. The Rust Belt cities that had powered America's 20th century growth became symbols of industrial decline. The economy shifted toward services, finance, and technology. Labor unions, weakened by massive unemployment, lost their power to demand wage increases. This helped keep inflation low, but also contributed to decades of stagnant wages for working-class Americans. The gap between rich and poor, which had been narrowing since the 1930s, began widening again. The strong dollar policy that emerged from high interest rates transformed global finance. Foreign capital poured into America, financing government deficits and corporate expansion. But it also turned America from the world's largest creditor nation to its largest debtor. Financial markets were revolutionized. The bond market, sleepy and predictable in the 1960s, became volatile and central to economic policy. New financial instruments emerged to hedge against interest rate risk. Wall Street's importance in American life exploded. Volcker stepped down as Fed chairman in August 1987, replaced by Alan Greenspan. But his legacy was cemented. The Federal Reserve's primary mission was now price stability, even at the cost of employment. This framework guided American monetary policy for the next 40 years. The psychological impact lasted even longer. Americans who lived through 20% mortgage rates developed a generational skepticism about debt. The inflation expectations that had driven the 1970s spiral were replaced by deflation fears that would shape policy decisions through the 2008 financial crisis and beyond. Internationally, Volcker's success inspired central banks worldwide. The European Central Bank, Bank of England, and others adopted similar inflation-targeting frameworks. The idea that central banks must be independent from political pressure became global orthodoxy. Chapter 6. Why this 1980s crisis mirrors today. What can we learn from Volcker's shock therapy as we navigate today's economy? The parallels to our current situation are striking and sobering. Like the 1970s, we've recently experienced inflation levels not seen in 40 years. Like then, it started with supply shocks, this time from COVID and Ukraine rather than oil embargoes. Like then, government stimulus poured fuel on the fire. And like then, the Federal Reserve faces the terrible choice between accepting inflation or causing a recession. The first lesson is that inflation, once embedded in psychology, is incredibly difficult to stop. When everyone expects prices to rise 10%, they act in ways that make prices rise 10%. Breaking these expectations requires dramatic action that proves the central bank's commitment. Half measures often fail, requiring even more painful medicine later. The second lesson is that there's no painless cure for high inflation. Volcker tried the gentle approach in early 1980 and it failed. The choice isn't between pain and no pain. It's between sharp pain now or worse pain later. Inflation is like cancer. The longer you wait to treat it aggressively, the more radical the surgery required. The third lesson is about credibility. The Federal Reserve's greatest asset isn't its ability to print money or set interest rates. It's market belief in its commitment to price stability. Volcker earned that credibility through immense political courage. Once earned, it made future inflation fights easier. For individual investors and savers, Volcker's era teaches crucial lessons. First, inflation destroys cash savings. That $10,000 under your mattress lost nearly half its value during the 1970s. Second, fixed-rate debt becomes your friend during inflation. Those who locked in mortgages before Volcker's shock paid them off with cheaper dollars. Third, economic cycles are inevitable. The boom always ends, but so does the bust. Perhaps most importantly, Volcker's shock reminds us that economic policy involves terrible trade-offs. There was no way to stop 15% inflation without causing mass unemployment. Politicians who promise painless solutions to economic problems are selling fantasies. Today's Federal Reserve faces its own Volcker moment. Inflation has resurged. Interest rates are rising. The question is whether they'll have Volcker's courage to finish the job, regardless of political pressure. History suggests the cost of failing is even higher than the cost of succeeding. The Volcker shock also reminds us that economic transformations have winners and losers. The inflation fighters of the early 1980s saved the currency but devastated manufacturing communities that never recovered. As we face our own economic challenges, we must remember the human cost of economic policy decisions. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel. because we're just getting started with these financial, educational mysteries.